Welcome to the Trader's Edge. I'm Jim Iuorio. That's Bob Iaccino. Bob, I'm using a new camera, and I think it's on like some setting that honestly makes me look a little younger. like, and I don't know how
There
to
is a
change.
setting.
I don't know how to change the setting. But is there like such a thing as a filter?
Yeah, there's a setting
I'm
in
not-
here
I'm not
because we have the
changing this
same
for
camera.
Yeah.
You have to you download the app and you can find the setting, and it kind of like gives you this Ingrid Bergman from Casablanca look.
That's what I want. I liked Ingrid Bergman and Casablanca.
Yeah,
There's
it's
about
under
80%
effects
of the people watching this going, Ingrid who? From where? Anyway, this is the Trader's Edge, and we would like to thank you guys all for participating. This is one of our favorite shows because of the audience participation. You guys can ask questions as we go. Bobby, Donald Trump seems to be ruining everything if you listen to the legacy, sky is falling, Chicken Little, morons on financial media. Which, by the way, I'm not a big fan of the things that Donald Trump's doing too, but are they exaggerating?
Yeah, I think they are. And, you know, it's funny to me because April 14th, so this is what, 23rd? April 14th, I tweeted that 12 months from now, market will be 19 to 22% higher, right? And I got a bunch of people coming back at me and people personally that know me reaching out to me and go, there's just no way. And the one person I was talking to, I said, did you actually measure it? That's not even the old highs.
Yeah.
It's literally not that far. Also, we're still up in a 2-year span in stocks.
Yeah.
So the last 2 years, if you measured that, we're still up.
Yeah.
And there's still a lot of strong data. You look at the S&P, and we'll talk to our guest about this, but you look at like the S&P manufacturing PMI today, that small to medium-sized business bumped up a little bit. Now it's pre-tariffs, you know, I'll admit that, but it's not that far pre-tariffs because it was the preliminary April data. Yeah. So there's still a lot of strong data points in my view. And now that they're backing off a little bit, I really think this is a Scott Bessent operation, not a Donald Trump operation. You agree with that?
Yeah, that makes sense to me too. And
all
I
these
think
people are saying, I'm sorry, Jimmy, but all these people are saying he's an idiot. It's not him. Yeah. He was just convinced by an extremely smart guy who helped Soros beat the Bank of England that they can beat China, that Trump can beat China. And I don't think he's wrong.
Yeah, that is funny that a lot of people don't realize what Bobby's talking about. Scott Bessent, George Soros, Stanley Druckenmiller, the third.
Druckenmiller, yeah.
Yeah, those were the ones who kind of banded together to take down the Bank of England back in, I can't remember what year it was, but pretty much an amazing financial story. Anyway, there is a guest, and you guys, I always introduce guests this way, and I'm going to do it again, is that you guys may have been watching Bobby and I on financial television for the last 25 years. You might think we are full of crap, and sometimes we think we're full of crap. But one thing you cannot deny is for some odd reason, we get great guests. This one will not disappoint. Let's bring in one of our favorites and our friend, Mike Singleton from Invictus Research. Michael, how are you?
What is going on with the buttons in the background?
What happened in the background? It looks like one of us is like I'm drunk. It's all blurry in the background, but I like it. It's fine.
No, not that. Our intros were all kind of screwed up.
Right. So here's my question to you. So you probably don't watch a ton of financial television. I don't listen or watch it much either. But on Monday of this week, and I know I normally start with some goofy questions about your hair or your college degree, but I want to get right into it. The notion, and see, it was all over CNBC saying, well, the reason the stocks are down is because Donald Trump threatened to fire Jerome Powell. It's like, what are you talking about? I mean, that just seems like it made no sense to me. What do you think about that?
I think that's just silly media post hoc explanation because it really never made sense for President Trump to fire Chair Powell. It would have taken a couple of years to get through the appeals process. His term only has a year left. It would have been all risk, no reward, so to speak. So I don't really think that was ever on the table.
And he's said things like that before. Donald Trump just speaks. If you're a moron in the market, or you want to sell out your entire stock holdings because Donald Trump said something that he said 10 other times in the last 2 years, I say let the seller beware if that's It's usually let the buyer beware. I know.
And you just have to like look at the way he responds. Like if you watch the question, his term can't be up quick enough. Would you fire him? Yeah, I might. I might not. I could. I'll look at that. We're looking at it right now. I might. We might not. I don't know. Yeah, we might. It's like it's not serious. It's just
He doesn't
Trump
like
being
to take things
Trump.
off the table, right? He
Yeah.
never does that.
And he just does it to aggravate people, I think.
And that's actually, Bobby, what you said, because I don't like that. I think you're 100% right. I think he believes that in negotiation, in campaigning, if he makes his opponents angry, then he gets them to look stupid. And by the way, he's had a crap ton of success with that. But I still don't think it's a great look. But this leads me to another question. Here's something I believe, Mike, and tell me what you think too. I don't want volatility-inducing comments to be constantly coming from the president's office. I think that's a bad look for the country. I think it's beneath us. That being said, I think a stock market that's continually taking punches, where average daily volatility is raised up because of him, eventually becomes stronger. I think that bear markets and even corrective markets many times happen from a lack of risk, low volatility, everything's going to be fine, and then all of a sudden, no crap, it's not. With him giving it punches every day, do you think there's any element to what I'm saying that's true? It could make the market stronger going forward?
Possibly. So I think that non-recessionary growth slowdowns, maybe that's the angle I'll take. Non-recessionary growth slowdowns tend to extend the business cycle because they result in underinvestment, as long as they don't culminate in job losses, right? Because it results in an asymmetry between consumption and output. And so if you're reducing your productive capabilities by underinvesting, but consumption remains flat, well, eventually you have to, demand outpaces supply, and as a business, you have to reinvest, right? And then you get another leg to the business cycle. So I think that there is an element of truth to that, yes.
So, Mike, most people don't believe that any of this has anything to do with outright trade deficits. Right. And I think it's mainly because the obvious answer would be because the economies are just so different in terms of their consumption. Is it possible to actually change the manufacturing base to a level that actually matters in pure numbers?
I think it is, yes. I think that's certainly possible. The United States has had a larger manufacturing base before. I think sort of famously during World War II, the manufacturing output of the U.S. was higher than all of Europe put together, and the U.S. was a much less mature country even at that point. The U.S. also has virtually no resource constraints in terms of raw materials. The only thing that we really don't have is a sort of a deregulated business environment and cheap labor. So we have some competitive disadvantages relative to other countries, but there's no reason that we couldn't have significant manufacturing in the future. That's kind of my take on it. There's other reasons that it doesn't really exist. The dollar system is a structural disincentive to manufacture in the U.S., and there's also financial incentives to manufacture abroad, right, for the sort of the bureaucratic administrative class in the U.S. But the short answer to your question is I think we could do more manufacturing in the U.S. It's probably a question of just how much.
Yeah, well, that was going to be my sort of follow-up. So I was looking at Apple and Tesla, for example. I think there was a third company, but I don't remember because I don't have what I wrote down right in front of me. But between those two companies, if they brought their entire workforce here, the total between the existing workforce and their foreign workforce would only be like 130,000 people. And what I'm wondering is, do you think that's just because of the fundamental change in the way manufacturing looks? You take somebody like Elon Musk, who's famously said that if a manager is not trying to create more efficiency than they currently have, he or she's not doing his job. It seems to me that even if we cut regulations and we cut corporate taxes, all that does is accelerate the move to, just for lack of a better word, I'm going to say robots, right? So if I'm right, and you're the one who knows, like I rely on your research every morning to tell me where wages are, right? Because you cover that 2 or 3 times a week, and how wages have been stubborn and they're still not consistent with 2% inflation. So is wages the only problem, or is it a fundamental shift in your view?
So I guess maybe part of your question is, has manufacturing become more labor or less labor intensive over time? And would sort of the advent of the combination of artificial intelligence and robotics preclude a significant amount of employment in the manufacturing space.
He says it way better than you did, Bobby, just so you know.
Fair enough.
Well, I think the answer is,
Right.
I think the answer is probably no. And I think that's because robots need components and the components need to be manufactured. And unless you just have this never-ending loop of robots building robots, there's always going to be a role for humans to be involved. And I think because desire, appetites are limitless, right? There's no limit to how many things human beings want. There's not like an output cap in terms of how much the U.S. could produce, right? If it had unlimited robotics. I guess this is sounding very abstract right now, so I apologize for that. But I guess my short answer is I think that there's always going to be a place for human beings in manufacturing. I think it won't just be design. I think it'll literally be part of the manufacturing process as well. I think it's just it's sort of an unknowable question of how much and when, but I think that humans will always be involved.
But make sure you tell the people too, because I honestly think there's a ton of people who think that Donald Trump is trying to bring back manufacturing to revive like assembly lines in small town America. That is not what we are talking about here, people. We are talking about not the mind numbing jobs where you turn one screw as the assembly line comes by, right?
Right. I think it's a couple of different things. So I think that there's a financial or a national security element, where we just need to build certain things within the borders of the United States for national security reasons. People talk about China building knickknacks or whatever, and why can't we get them abroad? And knickknacks don't really matter, but if it's an aircraft carrier component, it does matter. And you have to have the capacity to do that in the US, and you have to have the raw materials like steel to do that in the US. And so I think that's an important element of President Trump's manufacturing policy. I think there's also a social financial element to it as well, which is simply that real wages in the US or real wage growth has declined for the last 60 or 70 years. And people associate that decline in real wage growth and quality of living with manufacturing, because if you look at manufacturing employment as a percent of total and you look at real wage growth and you sort of chart them next to each other over the last 70 years, they look almost identical. And so I think what President Trump wants is a more prosperous middle class. And I think that more manufacturing might be part of that, but it's probably not the whole picture.
It's just more jobs in general, right? That's really what he's looking to do.
Right. Probably more jobs, but also maybe I would frame it a different way. So if you look at capital share of income versus labor's share of national income over the last 70 years, it's gone in one direction, right? Capital share of income has gone up, labor share of income has gone down. And I think that the Trump administration's view is to have a more prosperous middle class. Labor share of income has to go up. And I think he's trying to achieve that through a variety of means, one of which is changing trade policy, another of which is deportations, right, which reduces the supply of labor. And I think that ironically, it looks like the Republican Party is going to become the Labor Party of the next 10 or 20 years, which I don't think anyone saw coming 10 years ago. But there's already a couple of major policies in place that are going to put real upward pressure on wages and sort of a secular way. That's the House view at Invictus.
I want to read that comment that was just up on the screen by Widge because I like it. Opportunity breeds education. We need the opportunities to develop the workforce. That is what China has done over the past 25 years. We used to do that here. I just really like that one.
I do too. Yeah. Thank you, Widge. That's a good one. So let's talk about the state of the economy right now. My contention is that if you believe, like I believe, that there was somewhat of a K-shaped recovery starting in 2021, 2022, where I think the rich got richer and the middle got gutted and the poor got poorer. And now all of a sudden you take away $6 to $10 trillion, you zap that out of the market cap of the assets that the majority of those people hold. I contend that this puts us in a significant recessionary problem right now, maybe even that it's begun already. Do you think I'm just overreacting, sky is falling? Which, by the way, I always call recessions that don't happen, by the way, and I fully admit that. But this time it seems to me it's knocking on the door.
So do you think the transmission mechanism is the wealth effect? Like stocks go down?
Yeah, reversing the wealth. What I'm saying is that I think the transmission mechanism for the last 2 years was the wealth effect in the traditional form. And right now we're reversing that to a certain extent.
So I think in principle, that seems like it makes sense because I certainly, when I have a good day in the market, I'm more likely to buy an extra side at dinner or something like that. But when I try and find empirical evidence for that through the data, I don't really find a strong connection between stock performance and consumption. And even the very small connection that does exist, I'm inclined to think probably goes the other way around, right? Consumption growth drives earnings growth, drives stocks performance, right? Not as much the other way around. So it's I don't really have very many investment theses that are predicated on that, but it's possible that I just don't have the right data, or maybe I'm not understanding it well. But I don't think that the wealth effect is a primary driver of economic outcomes. I might say, here's maybe another way of framing it. I think recessions tend to happen when there's significant overcapacity in an industry or sector relative to future demand. And maybe that could happen within financial services. It's happened within technology. There's no reason it couldn't happen within financial services. It usually happens in housing because the Fed has a policy lever there, right? They can change demand really quickly relative to supply with interest rates. But when I look at the economy right now, whether it's housing, whether it's tech, whether it's financial services, I don't see substantial overcapacity anywhere that would lead to a recession, right? Unless demand just evaporates due to policy uncertainty or something that I can't predict right now. It's certainly possible. Anything's possible in markets. I just don't see it right now.
I want to put up Sterling's question, if I could, Jimmy. Thoughts on this one's a little abstract, I think, for the three of us, but we'll have a little fun with it.
Sterling's a smart
Thoughts
guy,
on
though.
how the what's that, Jimmy?
Sterling's a smart guy.
Yeah, thoughts on how the education system will have to change in order to usher in real automated industrial production capacity.
Capability.
I don't have kids, so go ahead.
Mike, that's you. I got nothing on that.
I generally shy away from policy-oriented questions. I don't know that I'm well equipped to answer this. I generally think that college education is not terribly practical, and you could make fun of the art history major or the gender studies major or whatever. But even within financial services, most of what I do now is not stuff that I studied with my finance degree. And I think I went to a good school and I studied hard. It's just sort of the nature of the beast.
Oh, I thought you went to Notre Dame. Go on, joke.
That's right.
Oh, that was cold.
Generally speaking, I'm a fan of trade schools, and anecdotally, the people that I've met that have gone to trade schools, I think are very smart and very competent, and generally they're doing pretty well financially. So, my intuition, not really based on data, is that that's a trend that's probably here to stay, and it's probably a necessary trend if we're going to bring back manufacturing, for national security reasons or other reasons. You have to have people that can weld and people that can fulfill all of the different trade roles. And so, whatever policies need to be put in place to make that happen, I think it makes sense.
So Sterling, I want to take a quick shot at that question too, because Mike said he definitely didn't want to make fun of the gender studies and art history majors, and neither do I. But I do want to make fun of their parents. That was a bad decision to just tell your kid at 17 to follow their heart and whatever makes them happy. If someone had told me that, I would have majored in watching SportsCenter in my underwear while drinking beer. You have to balance the notion of remuneration against your college degree. Now, that being said, there is something very policy interesting here. With $1.7 trillion of student loan debt that nobody was paying before, because they always thought the Democrats were going to wipe it clean. Now all of a sudden it's beginning to come due. Now we can change that into, Mike, do you think that's going to have a major economic effect, particularly in the housing market, if all this $1.7 trillion has to be paid back now from people your age, essentially?
Let's listen to her.
Again, I think the answer is in principle, yes. And when I think about housing just sort of abstractly, and I think about mortgage rates, and I look at the average selling price of homes, I think, how can people be affording this? How can the average person afford homes with 7% mortgage rates, given where incomes are? It doesn't really make sense to me. I keep thinking demand for housing has to go down. But then when I look at the data, it actually looks okay. Granted, mortgage applications are down about 50% or so from their peak in late 2020, but they bottomed maybe 18 months ago, and they've actually been trending higher since then. And we just got the new home sales data earlier this morning, up about 7.5% sequentially, near sort of a multi-year high, I think, just off the top of my head. It's still not strong relative to history, but it's certainly not collapsing. And, generally when I look at housing, which is oftentimes a warning signal for recession when it's going poorly, it just doesn't look recessionary to me. It looks kind of soft. It looks not like a full recovery. I don't want to sound like a liberal, but I kind of think that the U.S. needs quantitative easing to have a fully functioning housing market.
Stop it. You don't
because
sound like a liberal. You sound like a young person.
Right. Well, I think that generally speaking, 7% mortgage rates with 5% GDP growth, nominal GDP growth, doesn't work terribly well. So I don't know where I was going with that.
No, but can I add something to another layer of it? Because I think that what happened in 2021 or 2022, I guess is when it was, will be taught in business schools for the next 100 years. When you raise mortgage rates from 2.8% to 7.5% in 10 months' time, the rapidity of that move means that people lock up and nobody sells their homes. And what they ended up doing, instead of crushing the demand, they crushed the supply. I think it's freaking fascinating. You?
Oh, it is fascinating. And, if you would have had that insight prior to it taking place, you could have made a mint. It took everyone on Wall Street a long time to figure that one out. And I think policymakers never really figured it out.
Well, that doesn't surprise me at all. Bobby, you want to swing it back to markets?
Yeah, it is interesting what happened with housing there, because that big jump, that was the month of March, that data, and the 10-year in March went from 424 to 423. I mean, there was movement in there. There was a 416 settlement on the 10-year during March. So
March of this year, you mean, right?
Yeah.
Yeah.
And
right.
I'm talking about the home data that we got this morning, the up 74%. That was existing home data. But anecdotally, I am seeing prices drop dramatically. My wife and I are considering moving from where we currently are, not seriously considering it. So, of course, I signed up on Redfin and signed up on Zillow, staying in the same area, just moving out of this house into something else. And the price drop alerts are coming fast and furious. Now, granted, I was in a place where the market shot up. I'm in Southwest Florida. So the market shot up rapidly. It's likely going to come down faster than other areas. So what are you seeing in the overall price data? That's one of the things you do best, right? Is you do annualized and 6-month annualized, 3-month annualized. What are you seeing lately?
I'm still not saying, granted that all of this data comes out on a lag. The home price data is infamously lagged. And the Case-Shiller data, the headline figure comes out 2 months late, and it's a 3-month moving average. So add that all up and it's like 2 years late. I read the homebuilder earnings calls. I can hear them saying what you're describing, right? They're having to reduce prices just to meet demand. A lot of you're hearing numbers like 2 or 3%. It's just not in the data yet. And, I guess I'll react to the data when I get it. But and the homebuilder stocks, stocks look terrible, I think, on a technical basis, right? They're underperforming the broader market. They've broken trend. They're in downtrends. There's sort of a dissonance between what the financial markets are pricing in and what the hard data is suggesting, because the hard data looks fine to good, certainly relative to 6 months ago or 12 months ago. And the financial markets are clearly sending a signal like, hey, this is not going to last.
That's interesting. Today's beige book, inflation, mentions 3-year low. Jerome Powell's
I
cutting.
think inflation's gone, Bobby. You know that, right?
Yeah, but you've been thinking that for a while.
Well, no. Okay, but I accelerated that thinking. I before thought that 2.8 to 3 was going to be the norm for the next 2 years, but nothing above that. But with the zapping all the demand from with the asset price thing happening, like I said too, I think now I'm thinking 2.3 to 2.5. Mike, what do you see in the inflation?
Inflationary, right?
What's that?
But tariffs are so inflationary.
Oh God. Yeah. They're one-time inflationary if they're actually put on, and there is no 100% proof that the consumer pays 100% of it. The exporting country pays some of it through subsidies. The exporting company pays some of it through margin compression. The importing company, then it gets to the consumer, and even currency evaluations tend to adjust for tariffs too. So are tariffs inflationary? Of solid maybe. Mike, what did I get wrong on that?
I think they're inflationary on the margin. So like if you have a world with no tariffs and a world with tariffs, I think prices will be marginally higher in the world with tariffs. But it's like you said, it's very hard to predict how much. I did some basic math on the tariffs when Trump first announced at that press conference what the tariff rates were going to be. And of course, all that data changed since then. But my initial estimates were that tariffs would be about 100 basis point headwind to real growth and 100 basis point tailwind to inflation. But that's making a ton of assumptions, many of which might not pan out, right? A big one is oil, right? Declining oil prices are an enormous drag on inflation, and you can get everything else right on inflation in terms of forecasting. And if you get oil wrong, you're going to get the headline figure completely wrong, right? So I think oil has underperformed my expectations and consequently, inflation has come in softer than I expected. And so the framework I use when trying to think about inflation going forward is looking at the different components, the different drivers of inflation, and thinking about where they're likely to head. And so, I think that I'm inclined to think that we probably still see core and headline inflation in the range of 3% looking forward, because I think that oil is not going to trade to $0 or $40. Or at least it's not something that I would bet on. And I think the labor market is still a source of inflation. We're still seeing wage growth between 4 and 4.5%. I think that tariffs are more likely to be a tailwind for inflation and upward pressure on inflation than a downward pressure on inflation. So if you've got the labor market driving services inflation and you've got a little bit of an upward influence from tariffs on goods inflation, I think that gets you to headline inflation of, call it, between 3 and 3.5%. So I could be wrong. That's kind of the way I'm thinking about it right now.
Two quick things before I keep talking about markets. Tim put in the comments that, Bobby, I'm a realtor, because he lives like not too far from me. And then he said prices will be lower where I live in 6 months, which is why you haven't gotten a call, Tim, because we're not seriously talking about, we're just talking about it. But anyway, his third comment, which is okay to put on the screen, Luis, the latest grants shows the Fed's BS balance sheet. The Fed's bullshit is what I thought he was saying there. Latest grant shows the Fed's balance sheet grew by $3 billion over the past week, first time since the SVB failure, which they said they were going to do, right?
Yeah, thank you, Tim, though, because that's really important to me. And that's one of my main theses for being long gold, and things that Dennis Cartman used to say hurt when you drop them on your foot. And I think that's a big deal when they start expanding it again. But I need maybe 2 weeks in a row. What do you think about that, Mike?
To be honest, I have not seen that data, so I don't know what's driving it. Do either of you know what's driving it?
I do not, but I know I have that chart up all the time. I don't know how I missed that today.
Yeah. That's interesting. I wish I was deeper in the data on that one, but I don't have anything smart to say.
You agree, though, if the Fed starts quietly supporting bond markets? I know you mentioned before about QE. It definitely could be have a deleterious effect on the dollar and a really, really positive effect on gold, silver, copper, shit like that. Yes?
Oh, yeah.
Yeah.
No, I mean, I think to the extent that there's policy intervention, that's always a good thing. Whether it's enough to sort of arrest a bear market permanently.
Oh yeah, right. I forgot about stocks. Yeah, stocks could do well for that too if all of a sudden the Fed starts buying again. I mean, in the past it's helped stocks right back. Luis, let's put up the banner real quick. Can we take a quick timeout? Special offer for the watchers of this show. Tradier is offering 3 months free of Tradier Pro, which is an outstanding options trading system. We've had people on the show from high-end options traders, medium-end options traders, who all say this is one of the best services they use. 3 months free if you scan that QR code. Thank you guys. We consider it a favor to the show and a favor to us. If you do it, give it a go. Thank you guys very much. Back to the show, Bobby.
Yeah, so you do a lot of work on where the data is right now and what it's telling you about the very near future, but you're also very open to saying that may change. You say that in almost every daily edge, you say that's where it is now. It could shift. That's not our base case, but it could happen. It's one of my favorite things, because after I get used to watching your videos, your daily edge videos over and over again, I almost mouth those words when you get toward the end of where it's go. That of course could change, but it's not our base case. What is your base case? And I'm referencing, I tweeted on April 14th that a year from this date, stocks will be up 19 to 22%. And a bunch of people came in and said, are you calling for QE or rate cuts? Or I'm like, I'm not calling for anything. I'm just calling for what stocks do. Okay, we've gotten a nice big sell-off. And even if we continue lower from here, 19 to 22% from the close on April 14th was not even new all-time highs. So what's your base case on stocks, and what's the driver behind it in the data?
So I'll answer your first question first, and then I'll explain it. I think my base case is S&P 500 to 5,700. And what happens after that, I think I would need to take it from there and see how the data sort of evolves. I guess I kind of expect from 5,700 maybe a retest of the lows, but I don't want to commit to that. So essentially what I would say is right now, I think the stock market is pricing in a decline in real economic growth from about 2.5% today to about 1%. which would be generally aligned with my expectations for how tariffs will impact the economic data over the next 6 months or so. Maybe a little severe, honestly. I think that what the markets are pricing is maybe a little severe relative to what will actually happen. And when you look at the market internals, things have been very, very oversold. I almost feel like I don't even need to say it, but if you're looking at a momentum oscillator like RSI, if you're looking at different measures of market internals like the high beta to low beta ratio, I mean, you're talking historically oversold levels, right? That 2-day decline after the tariff announcement was equaled only by COVID, the great financial crisis, 1987, and the Great Depression, right? So I think there's two ways of looking at that. One is that's the neighborhood we're in. And the second is, are economic conditions really as bad as during those different events? I would say no. That said, I do respect the trend and sort of the technical conditions that we're in right now. Credit spreads are rising, right? Major moving averages for all of the stock indexes are now have negative slopes, and spot prices are below the moving averages. Market internals are kind of a mess, right? Oversold and in a downtrend is generally not necessarily a bottom. Cyclical sectors are underperforming more defensive sectors. So all of that is pretty bad, right? So I can't say I think we've bottomed and I think we're heading to a new bull market from here. I do think we get to 5,700. And there's also some good stuff that I could point to, right? Like, it's a little more esoteric, but if you look at how credit is performing relative to stocks, credit is actually performing a lot better. Credit spreads haven't widened to the extent that the VIX widened. And generally when that happens, it's a good buying signal.
So you're basically saying there's a lot of cross currents right now in your type of research?
Yeah, there are. The VIX went from over 50 to below 30. That's only happened twice before, but it was a good sign that uncertainty it happened in 2009 and in 2020. So stocks performed extremely well from there.
Those are significant areas of time.
By the way, I want to get back to something real quick, because you might just come on an indicator with me too, because I think credit spreads are very, very important. So you're saying, and remember, I quote Jeff Kilburg on here all the time too, and he said one time on TV, and I thought it was genius, genius coming out of Jeff Kilburg's mouth. No, I'm just kidding. He's a friend. He's a Notre Damer. But anyway, he said, well, I'll tell you, when the VIX is over 50, I just close my eyes and buy. And I thought that was actually pretty smart, because what it really was just an encapsulation of the Buffett thing. When everyone else is freaked out and panicking, you become greedy. But question is this, am I supposed to be balancing that, juxtaposing it against credit spreads? And if the VIX explodes higher, but credit spreads remain contained, then it's a buy the stock market thing. But if credit spreads are blowing out, it could be indicative of something far more sinister.
That's the gist of our research, is that credit is generally smarter than the VIX. And so when you see a divergence, you should tend in the direction of credit spreads.
Interesting. And what do you keep up? What chart do you keep up for a minute by minute view of credit? Just HYG and J&K?
Usually it's a spread measure. So it would be HYG over IEI is something that I look at. I look at the performance of leveraged loans, BKLN, the performance of BDCs, business development companies, which are basically like publicly traded private credit strategies. BIZD is the ticker there. Moody's publishes a daily BAA credit figure that I also look at, that you can use to either look at the performance of the bond itself or the credit spread. So a variety of different measures, and usually they're all signaling the same thing, to be honest. So
right. And Bobby, do you ever look at the CME product? They have credit spreads they launched.
Yeah, I've looked at it, but I never really liked the price action or the volume on it. So maybe it's gotten better. I haven't looked for a while.
Yeah, because as soon as that gets good and liquid, that'll replace everything else in my mind to look at.
It will too for me. Yeah. I want to ask you, because you did some research and you released it on how bad death crosses are as indicators. And when the death cross happened, okay, and for those of you that don't know what a death cross is, it's when the 200 crosses above the 50. Those are moving averages, of course. It happened on April 4th.
No, you said that wrong, right? The 50 crosses below the 200.
200 crosses above the 50.
Oh, yeah. Sorry. Yeah.
Below the 200.
Yeah,
Same thing.
Yeah. No,
right. I'm tall, you're short. Same thing.
Same thing. Go.
So,
yeah.
We're literally at like a half inch apart. But the 5,700 level, so it coincides to research I've looked at for years on these death crosses. So for those of you that subscribe to our newsletter on Slice, if you don't, it's at the link in my bio and it's Jim's pinned tweet. I I did a quick two chart thing on the death cross. And I started both of them off with saying death crosses are terrible indicators. Okay. There's no tradable thesis except one. Okay. Now you're always looking at things longer term. So I wouldn't expect you to see this or even look for it if you did see it, or even mention if you did see it. But if a death cross is to actually portend more downside, the market has to rally up to the level of the cross and then fail, which is 5,700.
Bingo.
Interesting.
If you look at it when we're done here,
when worlds align.
What's that?
When worlds align, it almost gives you
it's right where it is. Now,
Yeah.
the only death crosses I've ever traded, and they still haven't been that great, has been when the market rallies up or falls back down in the case of a golden cross to that cross level, and that holds. I also think when it breaks above there, like if it breaks above your 5,700, which is where that level is, that's not an all clear sign for me, but certainly a positive sign. So tell everybody just in quick terms what you found on a death cross, because they don't all subscribe to you, even though they should.
So generally what you said is what I found too. It's not a very good indicator. If you go all the way back to 1885, it's an okay indicator, but starting in 1960, it gets increasingly poor. The forward returns for the S&P 500 after a death cross are average, completely average. There's no statistical difference from average. The T-stat is like 0.05 or something. So it's more or less just noise. It's a headline on Bloomberg, and it's something that you should sort of click past and ignore.
Yeah. And by the way, these things have a name, like the evil Hindenburg Nazi tool of death or whatever. They name these shit indicators, and then all of a sudden it's like a death cross. No, it's yes, I agree with you. It is very, very soft as an indicator. Yeah.
So there's a couple of questions I want to get to real quick. Sterling has one. I think this might be as much for Jimmy as it is for what's your name? Mike. Speaking of QE, any thoughts on timing the Fed of at least stopping the reduction of their balance sheet if the 10-year keeps refusing to substantially fall?
Do you want me to take that first, Michael?
Yeah, Jim might have a better answer than me for that one.
So it has long been my base case. This is probably what, Bobby, 2 years maybe?
Yeah,
that deep down, the worry is, and what our path is leading to, is eventually the Fed coming back in and supporting auctions. Now, we've seen over the last 18 months, let's call it, 4 longer-term auctions that have gone very, very poorly. None of them have happened since the Trump administration happened, but something almost worse did. That one weird Tuesday, was it a week ago or the week before, where all of a sudden 10-year yields started screaming higher. They went from 3.8 to 4.4% in about the snap of a finger. That scares the shit out of people. And that's why I think that Scott Bessent went to Donald Trump and said, we got to start talking about good news instead of bad, because things are bad. And then Jim Bianco did some research saying that the selling was coming out of Europe. Then there was rumors that it could have been some sort of mistake from some big Japanese hedge fund. Either way, I think the worry will start to be, as soon as we cross 4.5% in the 10-year, the worry for people being short bonds is that the Fed comes in and starts buying bonds again. And I think they will do that. And that has been long been the thesis of why I've been long some of the dollar hedges like Bitcoin, gold, silver, copper, platinum, palladium. Mike, do you have anything to add to that or no?
Not really. Nothing investable in terms of timing. I would just say what I said earlier, which is I think that mortgage rates have to come down. I think the most likely way that happens is through QE. And
Yes.
so I think that it happens eventually. It's just the easiest lever for the Fed to pull if it wants to stimulate the economy.
Sure.
And
here's this what I'm going to ask you. Is it, if the three of us were the lever pullers and I said no QE because it could destabilize the dollar and push the thing up, you'd vote for QE? I consider you a smarter guy than me. You'd say yes?
I mean, from a policy perspective, I could talk about the policies that I would support in terms of housing, but they would sound completely ridiculous and not investable. I just think I think that I wouldn't vote for a politician because of QE, or I wouldn't appoint a Fed chair necessarily maybe just because of QE, but all else equal, I think the U.S. economy functions a lot better with QE. I think what would really be best for the United States, I'll give you my policy. I'm going to bite on it. I'll give you my policy proposal. I think the U.S. doesn't really have a housing shortage. It has a housing shortage around the major urban employment centers like New York and Boston and D.C. And the truth is you can't really add supply on Long Island. You can't really add supply around Boston, right? These places are tuna cans. right? So what you need is employment outside of major city centers, which historically was manufacturing. So you don't need jobs in Boston. You need jobs in Springfield. You don't need jobs in Manhattan. You need jobs in Albany. You don't need jobs in Baltimore. You need jobs in Hagerstown, right?
In Chicago, you need them in Palatine.
Yep.
Right. So I think that you need to have policy incentives to move employment out of these major city centers. And all of a sudden, an enormous amount of housing stock opens up as a potential for people to live. And there are plenty of beautiful, affordable homes all over the country that are not accessible to anyone right now, because the only people that live in these towns are retirees or people that didn't move out, people that work manufacturing jobs that are still there. And it's almost like these urban centers, maybe 7 cities in the US are functioning at 110% capacity, and the rest of the country is functioning at 5% capacity. To unlock a whole lot of value and a higher quality of life for almost everyone, you have to move the jobs around. And I think that that's something that could be solved with policy, but no one's talking about it. And I'm not a policymaker, so I don't think it's ever going to happen.
But the leftists are against that, by the way. And I'll tell you why, is they like the notion of crowded cities because they believe we do less damage to the planet. There's more opportunities for public transportation to get around and not as much need for a car. So if my daughter was here and she's a climate scientist, she'd argue against you for that. But I think the policy sounds fantastic, by the way, Bobby.
Yeah, I want to throw up Tim's comment about credit spreads, if I could. He says credit spreads in my CRE, he's a commercial lender as well, or he works in commercial lending, world are pretty good. Got a quote today from a large life co at 175 basis points over treasuries for a credit tenant project. I think they could be better localized, but certainly as an investment indicator, you have to look at a more broad base of them. Is that not right?
Yeah. And I'm not going to trade them. I'm just waiting for them. And when I see them begin to blow out, that's when I get short equities. Mike?
Yeah, I think that's generally right. And the reverse of what I said earlier was true too. When you see the VIX is low, but credit spreads are high.
Oh yeah.
That's a sell signal for stocks.
Right.
Yeah, that's a good one. I hear a lot of people talking about credit spreads lately, but I don't hear a lot of people combining them with the VIX. I thought that was great research when you did it.
No, I love that. Yeah.
Yeah, I want to ask you about wages again, because I don't think I really got the question out in a way that you know what the hell I was talking about. Are we getting any easing on the wage cycle now, or is it still at a level where it's inconsistent with 2% inflation? And do you see any other inflation pressures that could sort of supersede where wages are at?
Well, I would say generally speaking, wage growth has been declining over the last 6 months. Mm-hmm. If you look across the various measures that the government agencies publish, let's say it's declined from 4.5% on average to 4%. I think that's roughly right. So we are moving in the right direction, and the labor market is softening a little bit, right? You're seeing it particularly in hiring rates. You're not seeing it in layoffs. So, I think that the labor market could be a smaller source of inflation over the next 3 to 6 months than it was over the last 3 to 6 months. I certainly think that's possible. It really depends. If we get big tax cuts, I think that the labor market could easily tighten up again. I don't think that's off of the table. In terms of other, what should you look? The primary driver of the headline inflation figure is almost always oil. If you look at the year-over-year change in the price of oil and you overlay it against CPI inflation, the price of oil leads with like a 75% correlation, and it leads by 3 months. So I think to the extent that you have an edge in the oil market, you probably have an edge in making bets on inflation as well. And
go ahead, Mike. I'm sorry.
I was going to say I've from a technical perspective, oil's a mess, right? Like it's below all of its moving averages. It's, every time it gets a bid, it just gets sold off again right away. So from a technical perspective, there's no evidence that this downtrend in the price of oil is alleviating. But I will say you can't expect oil to trade down forever. So I think if you're betting on lower inflation because you think oil will decline 10% month over month every single month, I think that's a tough bet to make over time.
So I wanted to talk about oil real quick because it's interesting. Trump did this drill, baby, drill. That's what he campaigned on, right? But drill, baby, drill is kind of on life support at these prices. And for every $500,000 in CapEx that is not spent, we lose, I think, somewhere in the range of 500,000 barrels a day of future production. I'm sorry, 5 million CapEx. We lose about 500,000 barrels a day in future production. And OPEC now there was a couple of stories out today, and I'm actually looking at a headline right now, where OPEC seems to be falling apart, and they seem to be collapsing to pressure to let their members produce. I don't know if they see U.S. weakness again or what it is, or if they're just tired of being in this sort of lower production environment, losing market share to each other. Kazakhstan, maybe not a giant producer, but still in the million, 1.2 barrels a day range, is defying OPEC in terms of their quota. OPEC, a bunch of members are talking to OPEC about pushing another production increase, not just the one that they already announced they're going to do. And I'm wondering how much, we actually just got a comment from Stephen Orr. OPEC wants to dump a lot of oil into the market. Stephen knows a lot about this, by the way, if you guys don't know who he is.
I do know Stephen very well. Good to see you, Stephen. Yeah.
Yeah. So it's literally out there that, like, I wonder how much of this Trump will take credit for and how much of it he actually made.
Well, I can answer that. He'll take credit for all of it.
Right?
Yeah.
All of it. Right. But he does actually have influence, especially in Saudi Arabia. Right. So do you guys got any comments on that at all? Because oil, I'm about to put on a short oil position. I haven't done it yet. I'll put that in the,
but why? What's your target? To Mike's point, like it starts to get a little sticky down here. No.
I mean, I'll just say, just throw. I mean, sure, like logically it does. Just go back and look at your charts. I mean, I can point to a time in, let's call it 2016, 2013, where oil spent the majority of its time below $62.
Yeah, but the dollar was a different dollar back then too. The dollar was different back then too. You know what I mean? The dollar only has like
$7. Was different.
Yeah, the dollar's very different. That's what all these.
Well, a lot of things were different. I mean, I'm not calling it a one-headed monster or even a two-headed monster, right?
Oh, yeah, I know.
But I'm saying anyone who thinks that like there has to be a bounce at this level in crude oil is not remembering when we went to zero, when people went all the way down below zero, and people went all the way down. So it has to bounce, right? And I did say a trade, not an investment. And you guys know my average hold time is about 25, 26 days. So I don't see why we can't revisit the April 9th lows and possibly even go lower than that, especially if OPEC's dumping more money, as Steve Orr mentioned.
Yeah. Mike, do you have comments on oil, where the oil market could go? Or do you want to flip to, if you are advising a client of where to invest right now, what performs better the rest of the year in 2026, however you want to frame it?
So the first thing I would say is I think cheap energy is really great. So I think that's,
Amen.
That was always part of the Besant three-pronged plan for economic growth. And I think, cheap energy improves your quality of life, more than almost anything. So I think it's, from a policy perspective, I think it's great. In terms of where you want to be right now, tactically, I still like stocks, right? I think stocks go trade up to 5,700, and then maybe the death cross triggers and they trade down again. But tactically, I think stocks look fine. I will say, when you're in a risk off regime like this, and this won't surprise certainly anyone listening, I think, the best performing assets tend to be gold and 10-year notes or long-term government bonds. I like gold more than government bonds here because I think that, look, one's in a strong uptrend and one is a mess. So I'll take the strong uptrend. And from an economic perspective, right, gold is probably carries geopolitical opportunity as opposed to geopolitical risk right now. So I think that makes gold asymmetric relative to treasuries. But, you could test this a variety of different ways. You could look at economic conditions, but look, when stocks are below their 200-day moving average and credit spreads are above their 200-day moving average, historically we've wanted to be in gold and bonds. So I think that's tactically where you should be, or, maybe after this rally, that's where you should be looking to add.
Robert?
Sorry, I'm setting up my crude oil short.
We didn't usually know, people who watch and know, we don't really have our hand signals and we know exactly who's asking the next question.
Yeah, I wasn't watching, and that's my bad. I'm just telling you, like, my target for this particular trade is 55.45.
Okay, so that's not that unreasonable.
Yeah, I just don't see that as being something where, like, there's just been a lot of account collapses for people who thought crude oil couldn't go lower or couldn't go higher.
I have a question for you. And if Stephen, or if you're still watching, if you want to type out an answer too, is there other ways for the administration to provide incentive for domestic companies to go drill, baby, drill? other than the price, which is obviously the key incentive. If we remove regulations, and I don't know if we're doing so, I know there was talk of removing regulations. If we treat them better and nicer, will they start producing more, Bobby, or does the price have to go to 75?
I don't know. I mean, in terms of like them treating them nicer, I think they don't have a better situation than Trump. I just think it's the back burner for him right now.
Yeah.
So I really think that the
Yeah.
weakness we're seeing right now, to me, is the potential for a global slowdown based on trade tensions and OPEC dumping oil into the market at the exact same time. So literally the exact same time. So it's not the base case supply and demand for the next 5 years. It's certainly not what we're talking about here. But I want to put up Stephen Orr's comments. The administration loves crypto. That's going to be the big winner this year. The reason I want to put that up is because, again, on the Slice app where our newsletter is, I bought MicroStrategy this morning. And I want to ask you guys both what you think. I bought it as opposed to buying Bitcoin. Now, this goes against everything I ever stand for, right? But there's a guy on Twitter, Shadow Pro. He's a friend of mine. I know him personally. He interacts with us a lot. Pointed out to me why MicroStrategy might be the cheaper and more leveraged way to play Bitcoin.
Well, there's no question that it's the second part. Yeah.
Yeah. So is there any insanity you guys can point out, or is it something you can't off the top of your head?
No, I'm going to flat out call you insane. And here's what I'm going to say is that you are looking to leverage something that routinely moves 30, 40%. Is this a motorcycle thing? Do you have to get on a bike and drive 120 miles an hour?
I will tell you that from the cycle low on April 8th, we're talking about a 48% move about to where I bought MicroStrategy. So the stop is tight. I position size appropriately.
Which, by the way,
also I thought about doing it in options more than anything.
Well, I have traded MicroStrategy options before, but anyone who watched my early morning appearance on Maria Bartiromo at 5 a.m. on Monday morning, I did say the second it traded 88,000, I would buy Bitcoin because I thought it was breaking out of the whatever downward malaise it has. And we all three of us know that the malaise is because it trades as a risk asset with the NASDAQ. And when the NASDAQ is weak and sickly, Bitcoin is weak and sickly, but it has shown some signs of breaking that correlation. And there's been a couple days that it has, and my money is on the fact that it's breaking that correlation now. Mike, what do you got on Bitcoin?
I agree. I like Bitcoin. It's my biggest risk on position by a fairly wide margin. I think seeing that decoupling with the NASDAQ is bullish Bitcoin. I think it's also bullish risk more broadly. Like, do I think that we're going to see a sustained lack of correlation between Bitcoin and risk assets? Yeah, I mean, if the Pax Americana is over and we're going into World War IV, maybe, but that's not my that's not my base case, right? I don't think that's going to happen. I think
it'll be tomorrow, but it's not your base case today.
Yeah, it's definitely not today. I think that Bitcoin probably outperforms from here, and I think the fact that Bitcoin didn't sell off as hard as other measures of risk appetite did is a sign that we're going to 5,700 before we retest the lows, and it also opens the possibility that we could have seen the lows, right? I'd say a characteristic of every single market low ever is that no one believes it's the low, 3 or 4 months afterward. So, I want to be open-minded to the possibility that we have seen a low. Like I said, we've never seen the VIX go from above 50 to below 30 without it being the low. So there are signs that it could be the low. I'm open to it. And I think you want to own Bitcoin either way. There's an old technician's, sort of saying that through a bear market, you want to look at whatever is cyclical and leading the market at the same time in terms of relative strength. And right now, Bitcoin really stands out.
Love both those
comments. The issue with MicroStrategy is that Saylor sells his MicroStrategy positions to buy more Bitcoin.
And he mentioned about he sells, yeah. And he mentioned about Donald Trump. What he could do is dedicate more money to refinery repairs too. I think that's good input too, Stephen. Thank you very much. Bobby, do you got any closing comments before I go?
No, I'm good.
Michael, you got anything else you want to share with the people? Hair care products, anything?
Nothing from me.
We're just jealous. Bobby and I have been losing our hair. You're young. How old are your kids? Are they young?
Did you hear John out there?
Yeah.
John just turned 3 and Franco just turned 1.
That's so awesome. Good for you. I hope you're enjoying the hell out of it. I miss those times very much. And by the way, I never mind the sound of a screaming kid in the background. I think it's wonderful. So Anyway,
I thought about
thank
bringing
you.
him on the show, but I thought that'd be too much.
No, it's not too much for me, but it might be too much for the rest. Once in a while, Steph Pomboy brings her bulldog on the show sometimes, so you might as well bring your kid.
I'm a
Anyway,
fan of
thank you
bulldog.
guys for joining us so much. This is one of my favorite shows because I love the interaction. You guys get the support is amazing. Remember Bobby and I's mission. We were both in legacy media for 25 years, always at the whim of some overzealous producer or sponsor telling you what you could and couldn't say. We might be full of shit, but we want to find and create platforms where we can speak honestly. And we love our guests. Thank you so much. Mike, tell them where they can find you.
Invictus-research.com. And actually, we're launching a new AI product shortly, and you can check that out at invictusresearch.ai.
Nice. And for Bobby and I, you guys know we continue this conversation. We mentioned Trade Air quite a bit in our newsletter, Finance Unfiltered, which the letters happen to be FU, strictly coincidence. This has been Trader's Edge. I'm Jim Iuorio. That's Bob Iaccino. That's Mike Singleton. We'll see you guys soon.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.